Good morning, everyone, and welcome to today's webinar on constructions in the condition industry. On constructions in the conditions industry, on conditions in the construction industry. My name is Carmiana Matson. I'm with the Federal Reserve Bank of Minneapolis. And before I turn it over to Ron, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed next week to all registered attendees. Today's webinar is part of a series of webinars that we do on regional economic conditions. We've got two more coming up after this one on the subsequent two Thursdays. Next Thursday, we'll be doing one on the worker experience, and the following Thursday, we'll be hosting one on the health of Minnesota's childcare sector. And I will paste links to register for those in the chat box on Zoom. And at the end of Ron's presentation, he will have a few minutes for entertaining questions as well via the chat box on Zoom. So you can type those in the chat box and I will pose them to him. And then at the completion of the webinar, you will receive a quick 3-question pop-up survey at the end. We'd appreciate hearing your feedback on this event. With that, I will turn it over to Ron.
Thanks, Carmi, and good morning, everyone. To those that are returning, have seen me before, I appreciate your continued patronage. And for those that are new here, I really appreciate new viewers to this particular survey. I think there's some interesting results here, and we're going to go over those and take some questions. So hopefully we can all learn a little bit, including me from you with your questions. So before I get started here, I have to give you my disclaimer. So the views expressed here are mine and not necessarily those of the Federal Reserve Bank of Minneapolis or the Federal Reserve System. First, I want to give a little shout out to our partners and to respondents. There might be some respondents here that are watching and getting results. I appreciate your help with this. So for those that aren't familiar, this survey is done through partners. So I have a lot of construction and trade organizations that help me distribute the survey itself out to their member firms. It's actually the largest construction-focused survey within the Federal Reserve System, so we're very proud of that. That's all due to our partners and to their members, including some of you that are out there right now listening. And I just really want to say thank you. It's hard for us to get real-time information and information of some depth, and this survey really gives us not only a snapshot of conditions, but also a lot of depth from all the comments that people also provide us. So again, thank you to the partners that are out there. Thank you to the members that have been responding. So a little bit about the survey itself, this particular one. So it was conducted in early April. We got 255 responses, most of them from the Twin Cities in Minnesota. So what I can say is the results are very representative of Minnesota. Whether or not those conditions are similar in other parts of the district is hard to say, but I do think this is a good snapshot of the Minnesota construction sector, which is not very different from a lot of the other states. We have shifted this survey to a biannual, so it's over time it's gotten slowly a little less frequent, so we can kind of try to keep our responses up because we know there's a lot of survey fatigue out there. I just want to note that the window for this survey is a little bit longer than the previous one, but we're still comparing mostly similar time periods, so I don't see there really being any significant change in terms of how we interpret that data. Again, results are a snapshot. This is not a scientifically sampled survey. What I can tell you about the respondents is that you were able to respondents were able to note what sectors they worked in. So there's more than 255 responses because many firms work in different sectors. But this is the breakdown of how many how the sectors were represented itself. So a little bit lighter on the infrastructure and industrial. Lots of respondents in the non-residential and commercial space. So some of the takeaways. So what am I going to talk about? Generally speaking, the revenue trends remain positive overall. I would say there's some compression going on. I'm seeing some signs of caution and a little bit of slowing. Subsector activity is also positive, a little less so. I would say there's a little bit of difference. Industrial seems to be seeing the best metrics of those 4 sectors. I'll talk a little bit about that as well. The pipeline of new projects really is holding. This has been one of the most consistent measures that we've been seeing. I would not say it's overly positive or overly pessimistic, but it's kind of holding at modest levels. Cancellations are increasing. I think this is one thing that will kind of jump out, that we are seeing increased cancellations. Delays just continue to be a bad problem in the industry. There's challenge fatigue. I've been talking about this for some time. I know folks listening are not surprised at that. Supply chain, labor, high costs, all of those things continue to be significant problems. Wages are they've also been more of a factor, but they really are growing at a rate that we have not seen. So that's, I think, a challenge for businesses as well. And of course, now we're also seeing a rising interest rate environment. Frankly, it's really hard to overstate how difficult the current environment is. So I'm not surprised that we're seeing results that maybe are a little bit softer than we've seen in the past. But in spite of all of that, the outlook, firms are telling us they still remain net positive, which I think is really notable. So let's get into the survey results themselves. So in terms of recent revenue trends, let me give you a little bit of orientation too on how to, especially for those that are new to this webinar, I'll just explain kind of how I orient a lot of my graphics. So what we're doing here is we're asking firm revenue over the last 3 months compared to 3 different periods. The previous 3-month period, so quarter over quarter, then the same period a year ago or year over year, and then expectations for the coming 3 months. And what I do generally is in terms of color scale, red means bad, green means good, and the darker the color, the more to the margins it is. So generally speaking, what I take from this is that revenue trends are still positive. They're compressing a little bit. From a quarter over quarter basis, that's the top chart. They're very equal. So I think from a seasonal effects, we're not seeing much difference. And that I would say is notable in the sense that I would expect to have maybe seen activity start increasing quarter over quarter. Again, from a November to an April, not exactly, we're not into the busy season, but again, that's kind of where it is right now. From a period a year ago, we see more growth. That's the middle chart or the middle bar. And so I would say we're seeing some growth there, but we also know that some of that growth is simply from the fact that input costs have gone up, and those input costs are going through to the buyer. And so we think some of that, some of the inflationary effects are the result of that growth period or that growth outcome. But again, from an outlook standpoint, the expectations, the most positive bar on here is the bottom one. That's expectations for the coming 3 months, also pretty solidly positive. So thinking about it a little bit more over time, I do these repeated cross sections. So essentially I'm taking that same question over a number of surveys. So we've been doing this survey for about 2 years. I only have from October 2020. So each survey is represented on the left from a time frame standpoint. And in terms of revenue over the last 3 months compared with the same period, here's where you kind of see that little bit of pullback. I think things were really improving over roughly the last year, and now we've seen a little bit of a step back in terms of revenue over the last 3 months, again, from a trend standpoint. Still positive, just less positive than what it was. So on a sectoral basis, I have the results in there in the chart, and those vertical lines are the November 2021 survey. And I put that in there. It's kind of hard to represent too much in terms of comparison when you already have 4 sectors on there. So basically, the red equals that red line equals those that said it was negative last survey. The green line, those that said it was positive. So what we're seeing is a little bit of pullback from all of the sectors, a little bit differently. Industrial saw the least pullback, infrastructure heavy a little bit more, but in general, we're seeing kind of a pullback across most of the sectors. I should also note that I'll show a few other charts that show industrial seems to be doing a little bit better. I want to point out that that's the smallest sample in this survey. Roughly 11% of the sample did work in this sector. So just a little bit of caution not to try to overinterpret maybe what's been going on there. They do happen to be larger companies. There's many more firms that are over 10 million, even over 50 million in this sample. So again, I point that out just to help people understand how to interpret some of these results. So in terms of future expectations, again, the trend here I would say is actually quite stable. That's really the only thing I'm trying to point out here is that while recent revenue, the trend seems to be pulling back, there still does seem to be a fair amount of confidence in terms of future revenue growth. And I'll show another example of this a little bit later on. In terms of project cancellations and delays, I think here's where I think there are maybe a few signs of a little bit of concern. So we are seeing a very notable uptick in cancellations from respondents. Again, we're seeing a very consistent improvement over time, at least in terms of those that we're seeing it increase. We're seeing the red decline very, very notably, and then we've seen the uptick in the most recent one. There are lots of reasons behind that. I'm going to talk about that in some depth here in a little bit. Project delays, everybody listening here knows that this has been a problem for some time. problem is that it doesn't look like we've quite maybe seen the top of it yet, as it still continues to increase just a little bit. Seems like every survey. Again, as I note on the slide here, it's kind of more unusual now that if your project didn't see any delays, that might be more notable. In terms of looking at it by a sector standpoint, again, I think every sector is seeing part of this problem, not only with project cancellations, but project delays. Everybody's experiencing both of these problems. What it seems to be is that residential happens to be experiencing a little bit of the worst of both. And again, why there's probably lots of reasons why. I think the consumer side of this probably is a little bit more sensitive to a lot of the challenges that we're seeing out there. And there are probably other reasons as well. So we also ask, I think it's really important to know what the future looks like, the future pipeline, see what is coming online. And here I would actually say there's relatively good news. We've seen a general improvement, but also a fair amount of, I don't want to call it stasis, but we're seeing pretty similar results over time in terms of private projects in particular. So I would call it modestly positive in terms of the private projects that are coming out for bid. We're not seeing a lot of change in that. A little bit of change, again, if you were going to get nitpicky, you might look at the May survey, because that's roughly the same time frame. And while it's maybe a little less positive than in May, it's really not that far off from last May in terms of who was seeing increases or decreases and what the net is between the two of them. I would say the better news is on the public side, the right-hand side of the chart, which has seen, frankly, really quite consistent improvement in terms of the overall share and how that's balanced out, where we were seeing a net negative outcome earlier in this survey series. Now we're seeing it net positive, and the trend line is also kind of in its favor. So I think that's generally a good thing. Now, again, from a timing standpoint, we would typically see more projects come out for bid in this period. So we don't know whether or not there are seasonal effects here. Very possible. We'll have to wait for the next survey to really kind of tease that one out exactly. But again, on face value, I would call that a positive trend. From a request for new projects coming online, again, from a sectoral standpoint, I think here's also where you see a fair bit of strength in terms of the industrial versus some of the other. Again, because small size, take it with a grain of salt. The one thing I would note, though, is given the small size of their representativeness in the overall sample, the fact that we are seeing a fair amount of strength in industrial and to some extent infrastructure as well. I would also say that one possible caveat to some of the results that I'm giving you is that their underrepresentativeness might mean that the overall sector is actually doing better than what the overall results, which are more leaning towards non-residential and residential. It might be a little bit more positive in terms of overall activity. But it's a little bit hard to say. I just kind of always want to be able to kind of triangulate some results so people have a good understanding that, just because we see one thing doesn't mean it's necessarily this. Always have that additional explanation in the back of your pocket. So challenges. So again, I think we're seeing growth. I think we can't overlook the fact that that's a good thing, but we are experiencing lots and lots of challenges. That's not a surprise to anybody here listening today, but I do want to talk a little bit more about that. So one of the things we ask is what's the greatest challenge to operating capacity and productivity? And increasingly with just about every survey, we see the fact that material input costs, labor availability, and supply chain disruptions, it's kind of that, and everything else is not even noise anymore. Material input costs saw a significant increase compared to the November survey, and it's kind of in the same ballpark now with labor availability and supply chain disruptions. In terms of pricing, I'll go over each of those three, give you a little bit more detail on each. So there are wholesale price changes. What both of these do is compare what respondents said from November to April. And the left one is wholesale prices and the right one is retail prices. Basically, what we're seeing is that prices are increasing. They have been increasing at the wholesale and the retail. What we're seeing, if you were to compare the two, is that there's a little bit from November to April, we're seeing a little bit more weight into the retail sector. It looks like firms are passing more of their wholesale cost increases over to the retailer. We're also hearing that kind of anecdotally. We're seeing it in the comments. So I think firms are realizing they're in a space where they almost have to. The increases are big enough that they can't eat those. They haven't been eating those. They've been passing them along to the consumer, and the consumer continues to pay those. Supply chain disruptions, still a big problem. Again, pretty basic question, but we are trying to get over time some notion about how these things are changing. And still moderately, 3/4 of respondents essentially said so their supply chain, getting critical supplies is still moderately or more difficult. So, again, I don't see that necessarily smoothing out anytime soon, but it's something that we'll be tracking a lot. Also, in terms of looking at the sectors, just took a quick look at that. For the most part, there's really not much to report aside from saying all of the sectors are affected a little bit differently, but not notably. Labor availability continues to be a problem. Again, depends on how you want to frame this. Things have improved slightly. Here you have the last 3 surveys, August, November, April. We're seeing a little bit of improvement, but I would still say it's a very big problem. And if you go back to the February, roughly a year ago, the share that said things were very tight was only 1/3. So that's almost doubled still. And so we're still in an environment where firms are really, really struggling to get labor that they need. And again, that kind of falls into a lot of the delays that we see and other problems that are very challenging. The good news, that's not discouraging firms from actually looking for labor. So we are seeing very strong hiring demand over the surveys. It continues to get a little bit better even over the last year, and it's kind of a dual signal. There's kind of good news here and bad news. Strong labor demand for the Fed, that's very clearly a positive sign. That means there is demand. That means firms have work to do, but it also, I think the fact that they continue to be looking for work is probably driven a little bit by the fact that they can't find labor. So even more firms are looking because they're having that much difficulty finding labor. So it's kind of a good news, bad news. Hopefully, as some of these numbers start to come down, and again, if we can find, if labor continues to be strong and we can find more labor, very difficult problem, not going to be solved overnight, but I think that will help relieve some of the other challenges that we're seeing. Excuse me. Rising wages, also a notable problem. I'm going to show you 2 charts on here. This one is basically over the last year is the yellow bar, and then expected over the coming 12 months is the green bar. And what I would note here that is kind of notable is that normally what I hear from firms is that, especially where there's a fairly significant increase in wages over the last 12 months, firms very often think it's not going to be that bad next year. Okay, we've done that big bump. Now we're going to be able to pull back a little bit. So it's very often the expectations are that wages are not going to go up as much. That's not the case with this survey. In fact, I would say we saw a very notable jump in those that expect to pay higher wages, significantly higher wages over the coming 12 months. So that's a good, I think a good thing for workers, hopefully a good thing for labor availability, not a great thing for profit margins for companies. Again, just to show you and give you another slice of this data, over time, what we've seen is that firms have really upped the game in terms of their wage offerings. So it's gotten significantly more firms are giving raises, more firms are giving bigger wages, bigger wage increases. So 44% expect wages to rise by 5% or more next year. This survey's obviously, as you can see, never seen that share, and it rose fairly significantly from November to April. What are all these challenges? What kind of effects are they having? Not surprisingly, we're seeing the fact that, especially, we only ask about higher prices and supply chain effects, but as you can see here, they're having lots of negative effects on project timeline delays. They're having a big effect on firm profits and overall project demand. This is not particularly different than the November. I would say there's the tiny sliver of good news on this chart is that these measures improved marginally over November. So at least they didn't get worse. They got a little bit better. Margin of error, I think you'd have to say you're kind of in the same ballpark, but at least they didn't get worse. And my last slide here before we get to questions, despite all of this, normally I think if you were to just listen up to this point, if I were to ask you to guess where firms are in terms of the level of optimism, you'd be like, oh, we're going to see some decrease here for sure. This is one of the things that surprised me maybe more than anything, is that we actually saw optimism rise from this survey compared to November. And I can't actually explain it. I think it's because firms are just that resilient. I think the fact that there is demand is good. I think everyone is problem solving to a degree that they still expect to be able to get it to an environment that is more amenable, just and easier. At least, again, that's my conjecture. Anyone wants to send me some notes. Otherwise, I'd love to hear other alternative views on this. But again, I think the main point is that firms remain optimistic, and I think that's a really, really good sign overall for the sector. Among the 4 different sectors, they are all net positive, industrial being more so than any. Again, kind of keeping that theme from earlier that seems to be that in the components and factors that are influencing the industrial market seem to be fairly positive right now. So really quickly, my wrap up here. So revenue trends are still positive. I think we have to take growth at least at face value. There are lots of underlying things for that in terms of inflation and things, but again, I think that's a good thing. We are seeing results compress a little bit. The increase in project cancellations, I think that's a notable concern. I think that's something that we will obviously be looking into more, trying to find out more until our next survey. Again, I think underlying demand still seems positive despite the fact that we are seeing increase in cancellations. Industrial seems to be showing better signs than say residential, but both, on net, I wouldn't say residential is going in the tank either. I just think there's a little bit of degree of difference between the two. The conditions are challenging. Again, I don't mean to poke fun. It's kind of a rinse and repeat cycle right now. And what we're, I think, really going to be looking for is when are we going to start seeing an easing of some of those conditions? I think it's very safe to say that we are seeing some net signs of drag, of slowing. But again, from my viewpoint, the fact that firms are still overall optimistic, I think really suggests that there's just a lot of resilience in the construction market and among the firms and among folks that are listening today. So as Carmi mentioned, we do have some other upcoming rec webinars. I have them here. I believe Carmi's pasted some web addresses in the chat box. We'd love to see you there as well. The one thing that I will mention is that we have an ag credit. We haven't put that on the calendar yet, but I was kind of, for those that might be interested in that, my colleague Joe Mann will be talking about that. You can look for more information on that one in the future. So with that, Carmi, I would love to take a few questions. Looks like we're at 9:25, so I can take questions for about 5 minutes. Would love to.
Yeah, and there have been a few that have come in via the chat box. Folks
Sure.
out there can feel free to type those in the chat box. One thing you haven't mentioned yet, Ron, is the impact of the infrastructure bill that passed at the end of last year, the IIJA. Are you seeing any impacts of that yet going forward?
Well, and I appreciate someone bringing that up. I should have mentioned, I think that is probably what is leading the improvement in projects out for bid with the in the projects out for bid, that public sector. I have to assume that is kind of what underlies that improvement there. We don't ask specifically about the impact of that bill. And, again, the other part is, the fact that it's out there, projects don't automatically just enter the stream then. But whether or not maybe it just helps people feel a little bit more confident, I think might be part of the answer there. But we don't know exactly, what impact, because it's still more legislation than it is actual shovels in the ground.
Great, thank you. Another thing you haven't mentioned, the rate increase this week, largest interest rate increase we have seen in 20 years. What is going to be the impact of that, do you think?
I'm shocked I got that question, actually. The inflation impact, It's something that we are trying to follow very closely. Right now, I think what I see are some opposing early effects. I don't think there's any question that it changes the finance calculus. I think whether or not that is bleeding directly into that cancellation trend, I think that's very possible. What I am hearing is that others, though, I've heard some anecdote, and I can't say this is anything more than anecdote right now, but we are hearing that others are trying to accelerate projects in order to lock in financing that they expect would be higher if they wait. So I think there's a little bit of push-pull. And we're hoping that, in general, what we're hoping that the rate increases do is moderate demand to an extent that it brings it more in line with supply, because then I think some of the challenges that we've seen in terms of high prices, some supply chain problems, things like that, that they kind of start to repair a little bit without reversing too far and get into a negative scenario. So obviously it's a tightrope. We're following it very closely. For those that are listening, I'm always open. You have my email address down there. I would love any insights you have on that question. We really like to gather as many anecdotes as well as larger data that we can, so we can listen and really hear what firms are experiencing out there.
Great. Thanks, Ron. I'm not seeing any additional questions in the chat box. You must have been so comprehensive today that everybody's got all their bases covered. So with that, we will wrap it up. Thank you so much, everyone, for joining us. We hope we'll see you at the future webinars that we have coming up this coming Thursday and the one following that. We'll send an email next week with the links to Ron's slides and a video of this presentation. Thanks again for joining us. Bye-bye.
Thank you.